All right. Well, let's transition now into what we talked about. How many businesses are actually or realistically going to sell? It's very few, 0.02% or so based off some of this data here. If you are fortunate to have a liquidity event, there's emotional and financial things you need to deal with as part of that transaction. We broke some of that down. Now let's go into, okay, preparing my business for a sale. What are some things that actually move the needle? So we've got some data here from Harvard Law School and some McKinsey M&A report, and then also a Capstone Partners Capital Market report. And really what this is showing is that overall, M&A deals are up about 25% since 2024 in terms of the volume. So volume is coming back as interest rates are kind of plateaued or even decreasing a little bit. But on the flip side of that, valuations, or I should say as part of that, valuations are holding strong with a median valuation of 9 to 9.5 times, down a little bit from 2021 highs, but still strong. And then another data point, though, is that private equity, and we've talked about this in past episodes, the whole time up to 8.5 years versus 4.1 years in 2007, meaning that there's a bunch of quote unquote inventory that private equity is sitting on waiting to sell in terms of having second bites of the apple. So lots of dry powder there. So all that being said, though, we did want to pull out what are 6 different things that will help increase the value for your business. So I'm going to go through these real quick, and then I'm going to want your thoughts, Jim. The first one is pivoting from project-based to recurring-based revenue. So that's going to be one thing. Asset-light operations as opposed to large CapEx-driven businesses. Higher margin structure, so gross margins in particular, above 50%. Diversified customer bases, so having no concentrated customer that's greater than 10% of your revenue base. Management and team depth, so making sure that a great way is, could you take a 3-month sabbatical and would the business keep running without you? That'll really quickly tell you if you've got management depth. And then growth trajectory. We're going to measure that as 15% plus year over year top line revenue growth. And then those are the 6 things. There's one other thing that I think is important too, but it's kind of like they call it the rule of 40, which is if your profit margin plus your growth rate, those two added up equals 40% or above, that's a rough rule of thumb that it's a healthy business. So that's another kind of variable in there. Again, not so much related to M&A, but just overall rules of thumb. So as you're seeing this list of 6 different attributes of high value businesses, what are a few different things that stick out to you as you talk to entrepreneurs?
Yeah, I mean, these are the big ones, and I'm glad you laid it out like this. And even we're seeing so many companies trying to get recurring revenue. Like we were talking on the drive over about how a lot of CPA firms are now putting people on a monthly recurring revenue rather than paying for the return once a year. I think maybe they'll get some pushback, but I think if they're all doing it, that's kind of what you're going to have to do to pay for it. And obviously that's a big deal. The asset light operations, CapEx is a big problem, the high margins. So often entrepreneurs aren't worried about margins, but margins matter. Customer base. I will also add to the diversified customer base, diversified if you have distributors or if you have providers that you're getting product from or anything else. If there's a supply chain somewhere, if your supply chain isn't diversified, that could be a problem, right? If there's one provider of the ingredient that you use in your supplement and something happens with that one provider, you got a problem. Management depth is so important, and too often entrepreneurs hold on too tightly and they don't develop an executive team, and then the business is always going to be about them. And then, of course, the growth trajectory, growing consistently over time. Those are all really good.
I like it. Well, we got the visual up on the screen there, so you guys can check that out in terms of some of the biggest drivers here. And the last thing that we should dive into in terms of how do you actually get your business to sell at a high multiple, I think it'd be good to go through just 5 different founders, same exit, different outcomes. And so really here is that it's not just about the sticker price of a transaction. So hypothetically, if you hear, hey, there was a $30 million liquidity event, well, here's 5 different variables or factors that would greatly impact how much money did that entrepreneur actually walk away from. The first one is equity split. So if this entrepreneur was raising a bunch of money from venture capitalists, maybe they only owned 20% of that business. So owning 20% of a $30 million sale, that means you're getting $6 million pre-tax. A lot different than saying, hey, I'm the CEO and founder of a $30 million business that sold. That sounds great. People think you've got $30 million, but it really depends on the cap table. Second thing is deal structure. So cash versus earnout. We see this all the time, and that maybe the headline purchase price was $30 million, but maybe it was 60% cash up front, 18 million cash and 12 million of rolled equity into the newco or an earnout, and maybe that goes to zero, which we see happen a lot more than entrepreneurs would like to think. tax structurings. We talked about qualified small business stock and C corps, and the difference in how these are structured can make a huge difference on if that was maybe the first half of that $30 million is tax free, and then you're paying 20% on the last 15 million. You walk away with $27 million after tax. A lot different than if that were a hot asset sale and it was mostly taxed as ordinary income. Working capital adjustments, and then also rep and warranty insurance. Those are just other things, minutia, I would say, as part of the deal transaction in terms of how much money is tied up in the transaction. Because sometimes, it's a $30 million transaction, but you had to write a check for $5 million to leave ample working capital on the balance sheet in terms of accounts receivables, et cetera. So not all $30 million headline transaction prices are made equal, is the point.
Yeah, for sure. And I was thinking of a couple entrepreneurs that I know of, and they sold their company for $100 million, and everyone assumed they both got $50 million bucks. And the truth was that they had taken on investors, and they owned about half. That's $25 million each. But with the purchase, they were required to roll $10 million each. So they each got $15 million after tax. They each got $9 million. So people are thinking these guys have $50 million each, and they really have like $8 or $9 million each. And then the money they rolled in, the earnout didn't work out, so they didn't get any of that money. And you're not flying around on private jets if you have $8 million. And so sometimes you see business partners like that trying to live a lifestyle to live up to a $100 million exit, when really they need to be looking about how they're going to make money in the future, unless you can live off of $8 million, which, hey, a lot of people can live off of $8 million. But they're always thought of as the guys that sold their business for $100 million. And that's what gets put out there. But of course, did you take investors? What's your after-tax net in your pocket? Did you roll some forward that could, go to zero if the earnout doesn't work out? Those are questions that people don't ask, but that you as an entrepreneur need to ask as you're building out your wealth plan and as you're thinking about your exit. Because a $100 million exit in 10 years might not be what you think it's going to mean if you do any of those other things.
Yep. All right. Well, let's put this all together here from the fractional family office floor. And we talk a lot about what our clients should do, but let's talk about, do we eat our own cooking, and what did we actually do and why? And I know we've jumped into this a little bit, but let's deep dive into our ESOP transaction in 2022 and why we made this decision. So I think the place to frame this up, whenever any client or anybody is evaluating an ESOP, is, well, what are the options available on the table? And so the ESOP is an option, but so is a strategic sale. So this could be a sale to generally someone who's within your industry. That's generally going to get you the most value there. Then there's going to be private equity sale, so kind of more of a financial buyer. There could potentially be a management buyout or an internal succession plan. And then the ESOP would be a fourth option. So those were four different options that I know we all kind of discussed, and then we landed on the ESOP. And I'll give you my opinion on why the ESOP won from our perspective, but I'd love for you to kind of comment, just because I think that criteria will help other entrepreneurs who are considering private equity versus ESOP.
Okay.
So
I'll see if you give the right answer.
So I think the first thing here is alignment with values. I think that was very important, and that this did not result in the optimal financial transaction for you or me, right, or Mimi, but it was aligned with what we wanted to achieve longer term, which was creating a vehicle that can hopefully, and that has proven to create substantial wealth for all of our employees, meaning that not only do we think that we should be getting wealthy as we create value for our entrepreneurs, but our employees who help build this should be along for the ride. So I think it was very, very aligned with our values. I think another thing is that it was aligned with the timelines that we had put in place, given where you and Mimi as the original founders, and for me as a minority partner in the deal ahead of time, it aligned with our timeline of within the ESOP, you don't get all your money up front. You've got to essentially earn all of that money, and the ESOP will pay you off over time. And we had a long enough runway where it made sense for us to to get into that relationship instead of needing an immediate liquidity event because people are burnt out or there's a health issue or something happened. I think the last thing, which I think is a variable, but it did allow us to de-risk a little bit. And I'd say the de-risking to me really mostly comes from the tax arbitrage of, instead of paying ordinary income taxes on profit distributions, we now pay the lower capital gain tax rate on our essentially the note pay down from the ESOP, and through smart tax planning, we're both able to really greatly mitigate the tax impact. So I do think there is like a tax or taking chips off the table, but it's not a huge piece of it because we're actually sacrificing an immense amount of upside by going through that transaction.
I agree with what you just said. I'd sum it up this way from Mimi and my perspective would be, number one, we care about our clients and our entrepreneurs, and we feel that our company serves them and provides resources and helps them achieve things and do all the things they want to in their life, including charity and giving back and all those powerful things. And we knew after talking to private equity that they would destroy our model. They would start saying, why aren't you taking commissions? Why aren't you taking all these other ways you can get paid? Why aren't you driving toward raising assets and all the things that we don't do that make us different? They would want to add the revenue that way. And so I felt like this model is something that we want to see for entrepreneurs. We don't have kids. This is kind of our legacy, and private equity is going to destroy that model. So one was that. Second thing for us was staying involved in the business. We sell to private equity. They're going to want control. They're going to probably want me out. And I don't want to get out. I still want to be involved. I still love this business. I love working with amazing people like you and all the people on our team. And then the third thing was, as you already mentioned, like making sure the team is along for the ride. So I want the people who help us grow this thing, I want them to have a piece of ownership in the company, more than just being paid well and getting all the benefits and doing the meaningful work, but also enjoy the stock increase along the way. So those were the main reasons why we wanted to do it. And to your point, we knew that if we wanted the best financial outcome for us, we would have gone a different road. But there were other things that mattered to us as much or more than clearly more than the money, because we didn't take the money. And we could have taken bank financing and gotten a lot more chips off the table. But as you and I discussed, we have confidence in this business. We care about this business. I'm not worried about taking that much off the table immediately. And I don't like bank covenants and to be partnering with a bank in our business.
Yep, makes sense. And I think tying this back into the three different paths we talked about of all in on enterprise value or a lifestyle business, this is a real life example of us taking that middle road of we grew the enterprise value, had a quasi liquidity event, but we're able to de-risk and take some chips off the table in a systematic way over time while still retaining some upside through some upside warrants and stock appreciation rights into the continued growth of the ESOP. So I think this is a perfect example of, we talked about option A, B, or C. This is an example of doing kind of that middle ground of investing for growth and the liquidity event while also taking chips off the table and diversifying.
Yeah, it's been good for us.